Hi, and welcome back to Investment Banking University's Investment Banking course. This is, of course, the first side of the perpetuity that we're discussing, the build side, and we're continuing on with valuation methodologies. So the first valuation methodology is for a public company, and we do so with the formula TEV, standing for Total Enterprise Value, is equal to the market value of equity plus debt plus preferred plus minority interest minus cash. With the market value of equity, we're taking the share price times the fully diluted shares outstanding, including options and warrants. Cash is already counted in the market valuation of equity, so we do not want to double count, and that's why we subtract it at the end. The debt is going to be taken from the balance sheet as well as preferred, minority, and cash. The second valuation methodology that investment bankers use and others use in terms of the buy side is comp companies, also known as trading comps. The management team ultimately gives you 1 to 2 years of projections, or equity research comp reports allow you to get forward multiples, i.e. multiple of revenue or multiple of EBITDA, which then may be used for the basis for this valuation method. You can get comps from the general overview in the 10K, as it will discuss the target's comps there. You'll find comps with good multiples to then tell your story to the marketplace and get a certain valuation that you're trying to achieve. You're going to begin by selecting a universe of comp companies. You're going to choose 7, 8, 10 comps, and you need their 10K, 10Q, and analyst reports to get the total enterprise value for each comp, and then divide by each line item to then get a multiple. So first, we're going to locate the financial information on comp companies after we decide the universe. And the information must come from the latest filing, the 10K or the 10Q. We're going to print out the 10K, the 10Q, and analyst reports. We're then going to spread the key financial information, ratios, and multiples, and calculate total enterprise value. And this is going to be in your comp spread tab. So to get to market value of equity, we're going to use a treasury stock method. And that is exercisable options outstanding times the difference between the share price and the strike price all over the share price. We're then going to benchmark comp companies and get the multiple that the company is trading at for each metric for each comp, and then get the mean and median of the comps for the metrics. For example, TEV over EBITDA. And finally, we're going to determine the implied valuation, which means multiplying the mean and median multiple times the revenue or EBITDA to get to the valuation range for the target company. So the better the company, the higher the multiple and the better valuation you get. In terms of investment banking, private equity, and corporate finance, you definitely need to know comp companies and transaction comps, and you're going to have to be able to speak in terms of here are the comps in your sector. You get a higher multiple because you are operating in better markets, you have better operations, and then the multiple ultimately tells you which company is better, while margin analysis tells you why they are better. And a key sell side question is, which comp would you use to guide potential buyers? So you're definitely going to have to know that. The third methodology for valuation is known as precedent transactions or comp transactions. We're going to begin much like we do for comp companies by selecting a universe of comp transactions, and then we're going to locate the deal related and financial information. You're ultimately going to need the press release of the deal, the 8K, 10K, and 10Q. You're going to need to know the type of payment, cash, stock, or cash and stock. And then ultimately you're going to spread the financial information, ratios, and multiples to get to transaction TEV, the implied, and the transaction market value of equity, the implied. You're then going to benchmark the precedent transactions and then determine the implied valuation based upon the metrics that are derived from that. In terms of the control premiums paid, it's typically going to be in the 20 to 25% range, with the transaction multiple being an implied one based upon the valuation. We're going to need to determine whether the market is good or bad based upon whether people are paying good premiums, control premiums, or they're not. And when a transaction occurs, you're going to want to update the client on the latest transaction to show them the impact of the control premium being paid and implied multiple as well. And the one you're going to ultimately point to transaction comps that have the highest control premium. And we're going to discuss that more when we talk about the sell side and investment banking in particular. The fourth methodology of valuation is known as discounted cash flow, and this is the intrinsic valuation as opposed to the market-based valuation. We're going to spread historical financial statements, importing historicals, and derive historical ratios, trends, and variables. And these are going to be the drivers of future performance in terms of margins and growth rates. We're then going to project the financial statements, pro forma, and do revolver modeling to link the balance sheet, the income statement, and the statement of cash flows. We're then going to project the free cash flow, or FCF, and determine the weighted average cost of capital to find the discount rate. We've already discussed how to derive the cost of equity using CAPM, which is equal to the risk-free rate plus beta times the difference between it's actually times the market risk premium. So the market risk premium is of course what we're going to get from Ibsen, and this is ultimately the S&P returns over 70, 80, or 90 years. For the risk-free rate, we're going to use a 10-year treasury, and then in terms of beta, it's the leveraged beta of the comps to unlevered median of the comps, which is the unlevered beta, and it should be 5.5 to 2.5. And we're using 2-year to 5-year betas. And this is ultimately taking out capital structure and then relevering to the actual capital structure of the target. And with beta, we're putting a capital structure on an unlevered beta mean and median of the comps to calculate the WACC of the target company that we're going to be dealing with. In terms of the cost of debt, we're taking the weighted average of the tranches of debt, tax affected, and this is going to be found in the 10K, and the rates are going to be derived from the notes. If the company is private, we're going to get from the clients the tranches and their rates, and we may go to the DCM within the investment bank to get the approximation. Here we're showing a WACC curve in the optimal use of debt in terms of debt to equity ratio to minimize the rate, and you'll see that past a certain point of debt to equity in either direction, it becomes less optimal. So for cost of equity, 20 to 25% in private markets, and then no use of debt is an inefficient use of capital. And we're trying to optimize the debt to equity ratio to minimize the cost of financing, which is shown in this graphic here. The next step is we're going to determine the terminal value, which is the EBITDA multiple, is going to be almost 80% of the company value. The terminal value is equal to the LTM last 12 months multiple from the comps times EBITDA. And the perpetuity growth rate should be 2.5 to 3%. It should not be larger than the size of the GDP of the country. So we're ultimately from there going to calculate the net present value, or NPV, and determine the implied valuation of the target company. So we need the valuation date, and this determines the stub year fraction or period left for the year. The stub year fraction, the investor does not have a claim on the revenues before that, and so that's why it's there. The DCF, or discounted cash flow value, is always moving through time consistent with the valuation date. And in terms of investment banking interviews, they're ultimately going to test you on DCF, and everything else that you know is ultimately going to be a bonus. So do DCF to find the yield to decide whether or not to invest principal is what you're trying to do. And here we just have some infographics that visually show the valuation methodologies and the different ones. Of course, this is the public company valuation showing TEV equals market value of equity plus debt plus preferred plus minority interest minus cash. And here's comp companies, and then precedent transactions, and then ultimately our DCF on both of these slides. And so that's it for this video. We're going to continue on with framing valuation in the next video.